Hello and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the beautiful Pacific Northwest. It is Thursday afternoon and we are live on Facebook. I hope everybody's staying safe, staying healthy, staying sane. Before I go too deep into anything that I'm saying, I want to personally share my deepest concerns, my sympathies, my freak out. I don't know exactly how to say it, but for the people of Hawaii, for the people in Lahaina, which is on the island of Maui, this is one of my personal favorite spots on the planet. My wife and I go there frequently. We have a little timeshare there that we like to visit. Yes, we're timeshare people, and if you guys want to talk about the real estate and the economics of having a timeshare, I'm more than happy to have that conversation. You know where to find me. You can always reach me. I am an open book, as they say. But for those of you who don't know what happened, yesterday and the day before, there was a horrific fire that was started. I believe, they don't know just yet, but I suspect it happened from downed power lines. There's a storm off the coast of Hawaii, and the sparks came from that, but there were massive winds, like 60, 70-mile-an-hour winds that just lit the whole place on fire. And if you guys are familiar with Lahaina town, it is a beautiful place right on the waterfront. There's art galleries there, there's restaurants there. They're gone. They're all gone. We were there last year. We were planning to be there next year, and it's all gone. It's such a terrible tragedy for those people. Hawaiian people are such nice people. They're so good natured. They're so giving. And it's a tragedy when these things happen to anybody, but to see something like that we personally have been enjoying and going to for so many years, and we're hoping to go to for many more years in the future. I don't know what's going to come. I don't know who's going to rebuild and what it's going to look like, but it's not easy to do things like that in a remote little rock in the middle of the Pacific Ocean. And for those people that have lost everything, I truly sympathize. I cannot imagine how horrible this experience and this thing is, but we pray for those people, of course, and we hope that things improve quickly. And if you want to take any life lessons from any of this, which, take it with a grain of salt, but none of us knows how much time we have for anything. Nothing is promised. Nothing is guaranteed. What you think you'll be able to do tomorrow or the next day may not be available to us for any number of reasons. So by all means, if there's something on your list to do, don't wait. That's one of the things my stepdad used to tell me all the time. Don't wait, move your butt. And he was right then, he's right now. And anyway, that's just my my 2 cents on that. And gosh, it's horrible. I'm really broken up about this inside. Such a beautiful place and so many great memories there, so many great meals, so much great artwork that my wife and I have bought there and still have on display in our home. In any event, our prayers for the people of Hawaii. And having said all that, let me just jump in here. As I said in my little promotional teaser on Facebook before this event was happening, inflation's not going away as fast as we'd like it to. This is a really tricky situation. It's a big problem. It's not going to be easily contained. We want to be done with it. We were hoping that they would finish sooner rather than later with this problem, but it hasn't finished yet. In fact, it continues. And there was a number released today for inflation for the previous month. So for July of 2023, there was the CPI, the Consumer Price Index report was released, and it showed that inflation is actually ticking back up a little bit, not going down. And that freaked out the markets. They weren't totally freaked out at the beginning of the morning when I started looking at this, but they sure got freaked out in a hurry. And now we're kind of dealing with some aftermath and some backlash on that. And so I want to share with you guys, as you know, my technology skills are well, they're famous. But for what it's worth, I want to share my screen with you and talk about inflation a little bit and show you what's going on and what's happening. And so hopefully you can see my screen. And let me just start with the beginning. and we'll jump in and talk about more things. Okay, so what you're looking up here is what's known as the headline CPI. CPI stands for Consumer Price Index, and this is a measure of inflation. It is not the favorite measure of inflation for the Federal Reserve Board, but it is a darn good measure of inflation, as good as statistics can be. I forget who said it, but someone once said, you can torture statistics until you get whatever result and number you want. And, that notwithstanding, methodologies notwithstanding, let's talk about what was released. So this came out today, and it is backward looking, like all government statistics are, all economic statistics. This is for the previous month, so for July of 2023. And what happens here is there is what's known as a monthly print. So that is the number for the 30 or 31 days of that previous month. In July, we had 31 days. So the monthly print is for the month of July. But the rate of inflation is a calculation of 12 months. It's known as the year over year calculation. And what happens basically is when July of 2023 numbers become available, they add it to the 12 previous months. So June of 23, May of 23, April of 23, etc. And that last month, the one that would be July of 2022, goes away. And so it's a rolling average or rolling number. Every month you add one statistic and you discard another statistic, the one from the 12th month or the 13th month, so to speak. So why that's significant is because right here, I don't know if you can see this very well on the Facebook screen, but this circled in red, this was the value or the number for July of 2022. And it was pretty low. If you look at like June of 2022 or May of 2022, these were pretty high numbers. But July of 2022, for that one 31-day period, a year and change ago, this was a really low value. And this number went away, and added to it was a number that came out over here on the far right of the slide, and I'll show you what that number actually was. But when you replace a tiny number, and what this looks like, it actually looks like it was 0, or maybe even less than 0, or 0.1, but you replace a really tiny number with anything other than an even tinier number, and you add all those numbers up, it's going to go up. The 12-month total is going to go up, because you're replacing something with 0, let's say a value of 0, with something that's got a value of 0.2. Well, even if 0.2 is a relatively small increment, it's still a larger increment than 0.0. And when you add up all these other totals, voila, you have a higher product or a higher outcome than the previous month. And so that is what the markets are looking at, and that's what spooked the markets. Now, I've got another chart here. This is the core CPI. Now, what's the difference between core CPI and headline CPI? Great question. Maybe you had that question on your mind. Maybe you didn't, but I'm going to answer it anyway because, well, I brought it up because I wanted to answer it. So headline, let me start differently. Core CPI eliminates two components of the total calculation that goes into the measure of inflation. It eliminates food and it eliminates gas or fuel, oil. And the reason it eliminates that is because we're going to buy food and we're going to buy gas pretty much no matter what, right? I mean, those are essentials. And as a result of that, whatever the price is, we're going to have to find a way to feed ourselves and to power our vehicles so that we can get to work and we can live our lives. So the core number strips out what they refer to as the volatile food and gas prices, whereas the headline CPI has all of that lumped in together. So there are two different metrics, but if you notice, for the same month of July of 2022, the core CPI was significantly higher for that 1 month's reading than the headline CPI. And the reason is, again, because core CPI eliminates food and gas. And so in the core reading, we had a little bit more wiggle room, that if we got a number that was a little bit higher than 0, we could still squeeze out a decent year-over-year inflation reading. So that's kind of what this all looks like. So every month you get a new number that adds to the front of the chain, and the last number on the back of the chain goes away. They add up all 12 of those numbers, and that's what the year-over-year rate of inflation is. And so the year-over-year rate as of July 2023's reading showed a little uptick. And boy, the markets did not like that at all. Let me show you what the markets did as a response to that. Bear with me. We're going back to technology. I can do what I can do, but boy, oh boy, I get a little bit anxious here when it comes time to doing things that I don't do well. So what I want to show you here is this. Hopefully you can see my screen again. And this is a chart of the universal mortgage-backed securities. Okay, so this is basically the financial instrument that I create with our mortgage clients, whether they are buying a home or refinancing a mortgage. We create an IOU on their behalf, and that IOU is kind of sold, it is sold to Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac bundle up hundreds, if not thousands, of these IOUs, and they create what's known as a mortgage-backed security, an MBS. And those MBSs, those mortgage-backed securities, are sold on the open market to investors, primarily through like pension funds, 401ks, retirement accounts. And as people get older and get closer toward their retirement, where they want to preserve their capital, right? They don't want as risky an investment as you would find in the stock market, let's say. They want something that's stable, that's going to pay them a fixed return so that they can live off of that money. They oftentimes look at buying mortgage-backed securities or treasuries, US treasuries. That's what the US government uses to finance our debt. So this is a chart of the price of the mortgage-backed securities. And bonds, IOUs, are very weird. That's for those of you who are Superman fans. There was something called the Bizarro world in Superman where everything was backwards. That's kind of what bonds are. They're a little bit bizarro. They are backwards. So when the price of a bond goes down, and that's what this chart's showing, the price of the universal mortgage-backed securities, when the price goes down, the rate goes up. And so for the price, these red sticks here show that the price is going down, and the green sticks show that the price is going up. So as the price goes down, the rate goes up. What I want to do real quick is zoom out here, and I'm going to say a year worth. And I mean, we are basically coming down on price over the last year. And let me show you 2 years just to give you a real kind of, this is where we were. If you look at the far left of my screen, this is where we were in the heyday, 2021 into, this was 2 years ago. So this would have been what, August of 2021, very much in the heyday of that great market. Now, that market was great because the Fed had their thumb on the scales and it wasn't a real market. And we can argue whether or not this is a real market as well. But if you look, we were up here on the price and it's gone way down, right? This is a negative slope. I'm not much of a mathematician, but anyone who plots graphs and whatnot will tell you that this is a very negative slope. And so as the price has come down, the mortgage interest rates have gone up. I don't think that is a surprise to anybody. I'm just showing you what this looks like. Now I'm going to show you the 10-year treasury, which is it's not identical to the mortgage-backed securities, but it is a kind of a bellwether. What the US Treasury does is a very good indication of what the mortgage-backed securities are going to do. Now, this is an inverted chart, meaning that this is the interest rate that the 10-year Treasury is bearing. And if you look, once again, this is a very positive slope. I'm going to go all the way back to 2 years. to the heyday. And boy, oh boy, would you look at that. The 10-year treasury was down here in the dumps when back in August or earlier in 2022, 2023, and look at the rise of interest rates that we've seen. Now, we hit a peak over here, and then we came back down, and we're testing that peak again. This is not great news, guys. I mean, I don't mean to be flippant or cavalier or whatnot. This does not look great in technical terms, in trading terms. These are charts that show that we're not yet finished with inflation, or inflation is not yet finished with us, and there's still work to be done. Now, I've been telling you guys week in, week out for months that inflation was going to come under control, and it will. But when is the question? We were hoping it would come in faster than where we are, but it's going to take longer than expected. It just is, and we see that happening now. We see that there are things happening not just in the economy, but also in geopolitical terms that are going to cause pressures on inflation. Things that are happening in Europe with regard to the war in Ukraine, things that are happening now in Africa, if you've been following along with what's happening in Niger and the countries surrounding that, Nigeria, Algeria, and the pressure that France and by extension the United States as an ally are placing on these former colonies. This all has to do with natural resources. This all has to do with energy. This all has to do with money. I mean, I don't want to come off as a cynic here, but you know that I'm going to tell you my honest opinion and my honest read on things. What has happened in Africa over the centuries through colonialism is not a good thing, and it continues, and the African nations are starting to push back on that a little bit. And that pushback, whatever you may feel about the propriety thereof or the impropriety thereof, but that pushback is creating uncertainty with certain things, certain commodities that are really important. For example, there's a huge pipeline that runs through these countries up to Europe, and that pipeline is delivering natural gas and other forms of energy that they are no longer getting from Russia, and that they're no longer getting from other pipelines. And so any sort of instability, any sort of whiff of potential problems there is going to be a huge pressure point on fuel costs, and fuel and food is massive. This is why the Fed kind of eliminates that from the core reading, because as they know, food and fuel, you're going to spend that money on that no matter what. So speaking of going back to the Fed here real quick, let me share my screen again. I'm getting very, very comfortable with this. And so here we go. I'm going to share my screen. Boom. Awesome. Okay, so this is, let me pull this up. Come on, there we go. So this is what goes into the consumer price index. These are the categories of economic spending, not all of them, but a lot of them, and how they are weighted in the calculation that the Fed uses. Now, notice that gas and food in yellow here, they contribute to the headline, but they do not contribute to the core. And so keep that in mind. But what does contribute to the core right now? Used cars makes up 3.5% of the core reading. And if you've been looking for a vehicle recently, you would know that used cars and new cars to a degree, but used cars especially, have been just crazy expensive. But here's the good news. Month over month, so from June to July of 2023, the cost of these things was down 1.3%. Year over year, from June of 2022 to June of 2023, this is down 5.6%. Insurance, medical, I believe this is medical insurance, 3.3% of the total 100% of the inflation reading, 3.3% comes from insurance. Airline fares, not my favorite. Like, look, I fly a lot. I love to travel. The airlines are not my favorite, but in any event, 0.8% of the total calculation. And from last year, July, to this year of July, the cost of airfares has gone down by 19%. I don't know if you guys have experienced that. I don't know where they get these numbers from. That's a real question mark. But moving to the big ones, all right, let's jump forward here. Shelter. Shelter makes up 43.6% of the total consumer price index. That is almost half. And if you add rent and owner's equivalent of rent to that, this is all housing related. You're looking at, quick math here, 43 plus 32 is what, 75 plus another 10%, I'm rounding up. You're talking about 85% of all of this core inflation, not including food and gas, but 85% of that stuff comes from shelter, rent, and owner's equivalent of rent. Down here in the black, I couldn't get this this copy just right, but this is also shelter away. So basically hotels and things of that nature. But if you look at these big, heavy readings, you're seeing that we're still showing month over month a positive number, but from year over year, we're coming down. So we're at 7.7% inflation down from 7.8% a year ago. We're at 8% inflation on rent, down from 8.3% a year ago. So small little movements in these things. Now, this is a weird calculation, guys. I don't pretend to know exactly how they come up with these calculations and what exactly goes into the OER, the owner's equivalent of rent. I'll dig into it. I'll give you guys a real deep dive if you want to do something like that. But in general, a top line view, I'll tell you that rent, as an example, is a hard thing to calculate year over year, because when you sign a lease agreement, it's typically for that year, right? It's not a monthly calculation. You're not renegotiating your rental costs every month. You're going every 6 months, or most likely every 12 months. And so it takes a while for those old leases to expire and the new ones to come to term, and then you renegotiate and you say, okay, well, look, I'm not paying you the same rent I was paying you a year ago when things were crazy. I can't afford it, or whatever it is. And so these, especially these numbers right here, the big ones, the ones that make up the bulk of the consumer price index calculation, they are what's known as lagging indicators, meaning that they take time for real data, for real-time data, for all of the changes to cycle through and get to actually impact these numbers in a significant way. And so we say that inflation is coming down. It has come down. We are now, well, it ticked up a little bit on the headline, but on the core, we're actually down from 4.8 to 4.7, still well above, still more than twice what the Federal Reserve Board wants to see for inflation, but moving in the right direction, albeit slowly. And so this is causing tremendous pressure on the markets. It's causing tremendous pressure on interest rates. Of course, it's causing tremendous pressure on buyers. And to a certain degree, it's freaking out sellers because they don't want to sell and get out of a great mortgage that's at 3% that we originated for them in 2021 when things were in their peak, and they don't want to go into something that's in the 7% range or higher. And that is causing supply to be extremely limited, and that is causing demand to not be satisfied. And so prices are going up. So let me show you one piece of good news here. I'm going to do one more screen share here. Holy moly, if I get this one done, it's going to be like the trifecta. It'll be all three of my screen shares will have worked. Let's see. Here we go. Okay, fantastic. I don't know if you can see this very well. I hope you can. But if you'll look, this is from like a week ago. These organizations, Case-Shiller, they still have not released their June numbers yet. FHFA, this is the Federal Housing Finance Authority or Administration, not the FHA, but this is the agency that supervises Fannie Mae and Freddie Mac. CoreLogic, Black Knight, Zillow, all of these are groups that are basically keeping tabs on values and pricing of single-family homes nationwide. This is not specific to the Pacific Northwest. I would say that the Pacific Northwest is a unique creature when it comes to many things, but in real estate terms, there's just not a lot of inventory, hardly ever. and there's not a lot of new construction here. It's not like Texas where you build neighborhoods. It's not like Arizona or Florida or Nevada or some of these other states where it's wide open, it's easy to build, and it's easy to get permits. The Northwest is an outlier in that regard. So I would add a couple of percentage points, if not more, to these numbers if you're looking specifically at our region or the Seattle area, the King County area, whatever it is. But if you look at these numbers in general, these are monthly statistics on price appreciation, and this is the pace that these organizations are suggesting we are setting for the entirety of 2023. So CoreLogic, Zillow, they're saying we're going to see a 10% increase from January of 2023 through January of 2024 or December of 2023, however you want to look at that calendar year. 10% increase. Black Knight saying 6%. Case-Shiller, which is the gold standard of these sorts of things, they're on track right now for 5%. So they're a little bit more conservative in general, but they also haven't released the number for June. And so my point in all of this is that despite the fact that rates are not where we want them to be, despite the fact that the economy is taking a lot longer to get where we want it to go, people still need homes and people are still buying homes, and the shortage of inventory, the contraction of available real estate to purchase is causing things to go up despite all of the doom and gloom. And look, I'm part of that. I'm not part of that doom and gloom, but I experience it as well. I'm working in this market. I have clients in this market that are buying homes that are asking, like, should we lock in our interest rates or should we wait and maybe we'll get a little bit of a break? To which I say, what kind of break are you expecting in the next 2 weeks? Right? It's not gonna, your rate's not gonna come down by 0.5% in 2 weeks. It might go up by 0.25% in 2 weeks, but it certainly is not going in the right direction right now. And those are hard conversations to have, guys. These are not fun times. This is not the best economy. I'm not here to sugarcoat that for you, but I will tell you that there are still people out there buying homes. I still have clients that are trying to buy a home in a very specific neighborhood. They've been trying since January. It's August. They continue to get outbid. There are still crazy sorts of offers being written and still some very, very strange things happening in our market, despite the high interest rates, despite the strange inflation, despite all of these other things. And now we're starting to see other cracks. I don't have a whole lot of time to tell you, but or to show you all the statistics, but we're seeing the rate of unemployment going up. We're seeing that as we dig through the numbers a little bit, we're seeing that the unemployment statistics that are being relayed to us, that everyone's celebrating, like, wow, we're making a lot of jobs. Well, in reality, we're not. We're making a lot of part-time jobs, but we're cannibalizing full-time, better paying jobs for those part-time jobs. Now, it reports really great. It's very flashy when you add 500,000 jobs over the course of 30 days as they do their reporting. But then when the statisticians and the economists dig deeper and they find out, oh, these aren't really 500,000 new jobs, they're, you know, a loss of jobs and a lot of part-time or seasonal jobs. By that point, the news cycle has moved on and nobody really internalizes that these are not outstanding jobs that we're adding. That's not to say that that's a good thing or a bad thing. It is to say that it is a thing that the Fed wants to see happen, meaning that they want to see higher rates of unemployment. Because when people are not working and when they are not confident in their job stability and security, they're not spending money. And that's what the Fed is really trying to do. That's what the rate hikes are all about. That's what their entire policy is geared toward, getting you and me and our neighbors to sit tight, sit on our hands, not spend a bunch of money, not drive prices up. And as prices come down, and you've seen these charts, then the rate of inflation comes down as well. And as the rate of inflation comes down as well, then the economic cycle kind of turns a corner and we go from a contraction, which is where we are right now, back to an expansion. It sounds strange to say it. I've been saying it for a long time. It seems kind of like a game, and it is in many ways, but it's real life, and we're all living it. and we're all going to be continuing to work through it. So with that in mind, my goodness, it is 2:30 on the nose. It's amazing how time flies while we're having this kind of fun. I hope you guys are learning something. I hope this is of value to you. I want to thank you for spending a little bit of time watching this, and I would love to hear from you. I'd love to get some questions, some feedback, something. So y'all send me a PM, a DM, comment on this thing, whatever. You know how to find me. You can see the logo behind me. My contact information is there as well. Please don't be a stranger. Reach me if you have questions. I'd be happy to share information. Until next time, please be safe, stay sane, stay healthy, keep the people of Hawaii in your prayers. It's a beautiful place, and hopefully they'll be able to rebuild and recover. And I will see you guys next time, same place, same time. Until then, have a great day. Y'all take care.